Which currency pair should you choose to trade? That's a really good question. And knowing how to answer that is really important. I like to think of it like this. Imagine you are watching two boxers fighting. One is very strong and one is very weak. It's a mismatched fight. Now, if you had to guess which boxer would win, you'd obviously guess the stronger boxer. In a very similar way, I look to trade currencies which have opposite outlooks to each other. So I want to pair up a strong currency and trade it against a weak currency. When you develop this mindset, and each day, each week, or even month, you're looking to pair up a strong currency against a weaker currency, you will find it much easier to project the direction of those currency pairs. So in this video, I'm going to show you a currency pair which I think demonstrates this principle of trading a strong against a weak currency. I hope you enjoy the video.
The currency pair I'd like to look at is the Australian dollar, New Zealand dollar currency pair. Now, looking at the New Zealand dollar side of the equation, in November 2019, the RBNZ kept their rates at 1% versus an expectation for them to cut rates to 0.75%. This was more bullish than the market was expecting. On top of that, recent data has been strong. Fourth quarter CPI came in at 1.9%, and that's just 0.1% tick down of the 2 to 3% RBNZ target range. The third quarter GDP surprised to the upside, coming in at 0.7 versus 0.6% and a prior of 0.5%. Also, annual average GDP year on year beat the market's maximum expectations of 2.5% with a print of 2.7%. So all in all, the RBNZ rate cut expectations for a 25 basis points rate cut are now only at 5% for the whole year, and there's only a 25% chance of a cut this year rather. Looking at the Australian dollar, well, the Australian dollar outlook is decidedly bearish. There's US-China trade war concerns over phase 2 of the US-China trade deal. And remember, 30% of Australia's GDP comes from China, so what's bad for China drags down the Australian dollar. We also have the Australian bushfires, which sadly will also drag down on Australia's economy. Coronavirus concerns will again weigh on Australia's economy. Not only is there the strong trade links between Australia and China, but also note that around 25% of all tourist spending in Australia comes from the China tourist market. The RBA were hawkish at their December meeting, and there has been recent strong employment data, hit a 9-month low, for instance, at 5.1%, and that has been supporting Australian dollar. However, the risks remain. Trade war, bushfires, coronavirus. So there is a genuine concern that the Australian dollar, New Zealand dollar currency pair will reach a divergence. So what are the risks to this outlook? Well, the risk to the outlook is that we get an unexpected bullish shift from the RBA. Their rate statement is in a few hours on February the 4th. And again, the RBNZ data there's some key data out for the RBNZ this week. So let's just take a look at the chart. If that Australian dollar, New Zealand dollar divergence continues with weak Australian dollar and a stronger New Zealand dollar, what we expect to see is more Australian dollar, New Zealand dollar downside. So for example, a key potential area, if this outlook remains, is any retracement back up into this 50% Fibonacci retracement level around the 1.0600 handle would be a potential place would I expect to see sellers should this strong versus weak expectation remain. Now, just a few things to look at. The first thing to look at is if there is any divergence or difference in this outlook. So February the 4th, we have the RBA rate statement. So in order for this outlook to be valid, we need to continue to see dovish tones from the Australian Central Bank. Also, there's some key employment data and inflation data out for the New Zealand dollar on February the 4th and Friday, February the 7th. So ideally, for this outlook to remain valid, we want to see a bearish RBA, and then we would like to see some on-target or strong employment and inflation data out for the New Zealand dollar. And if that situation remains, then we have our weak and our strong currency pair. So use this principle to choose which currency pairs to trade, the strong versus the weak. It's a principle that will greatly help you predict and trade the correct direction of the currency pairs that you're deciding to choose.